At some point, we all ask that same question. Can I actually afford to retire? Well, today, we're going to dive into a fascinating, real-life case study of someone facing that exact problem, but with $1.3 million in the bank. We're going to break down an expert's advice and uncover some lessons that might just change how you think about your own retirement.
It all boils down to this one question, right? It's so simple, but wow, is it complicated? A 60-year-old looking at their life savings and just wondering, is this enough? Is it time? That's the big question we're tackling today.
Okay, so before we can even get to the advice, we really have to get to know the person behind the portfolio. I mean, what are their goals? What are their assets? And, maybe most importantly, what's pushing them to want to retire right now?
First things first, our protagonist is a 60-year-old tech worker. So they're right at that age where retirement isn't some distant dream anymore. Nope, it's a very real possibility, and it's staring them right in the face. Okay, so after years of hard work, they've managed to build up a nest egg of $1.3 million. Now that is a ton of money for sure, but is it enough to last for the rest of their life? That is quite literally the million-dollar question.
So here's the target they're aiming for, $80,000 a year. That's the number they need to pull from this portfolio to cover all their living expenses. This is the key metric that the entire retirement strategy has to be built around.
But look, this is never just a numbers game, is it? There are some really powerful, personal reasons driving this decision. We're talking about health concerns like blurry vision from staring at a screen all day, inspiration from a friend who's already living a stress-free life abroad, and of course, that lifelong dream of traveling the world.
So, you've got this really complex mix of personal dreams and financial realities. What do? Well, this person went to an expert, and the advisor came back with this beautifully simple, two-part strategy designed to handle both their immediate needs and their future goals.
So here's the big idea, and it's brilliant. Instead of thinking about it as one giant pot of money, you split it in two. Part one is all about generating a steady paycheck, cash flow to pay the bills right now. And part two, that's for the long haul. You invest the rest for growth, so your money doesn't just last, it actually keeps growing over time.
Okay, so how exactly do you get that cash flow? I mean, that's the magic trick, right? The advisor didn't just throw out a vague concept. They recommended some very specific tools to get the job done. Let's meet them.
The advisor pointed to 3 specific high-yield ETFs, JEPI, JEPQ, and QQI. And you can see why. Look at those dividend yields. We're talking about 8%, 10%, even up to 12%. But there's always a but, isn't there? There's a trade-off. As that yield goes up, so does the potential volatility, which really just means the price of your investment can swing up and down a lot more.
Now, hold on, because that juicy yield isn't the whole story, not by a long shot. We have to talk about something nobody loves to talk about, taxes. Seriously, the way these funds get taxed can make a massive difference in how much of that money actually ends up in your pocket.
So each of these is a little different. JPI is known for being pretty tax efficient. JPQ's payouts, on the other hand, are often taxed as ordinary income, which is usually the highest rate you can pay. And then there's QQQI, whose payments are sometimes called a return of capital. That's a fancy way of saying you're getting some of your own investment back, which can delay the tax bill. The bottom line here, you have to look at the after-tax return, not just the big number on the tin.
All right, whenever you're dealing with tools this powerful that can generate this kind of income, you have to be careful. The advisor was extremely clear about this, laying out some critical warnings. This strategy is not for everyone, and it comes with some very real risks you need to understand front and back. And the advisor couldn't have been more clear about who this is for. It's for people who are already retired and need to create an income stream from the money they've already saved. It is absolutely 100% not for young people who are still in that wealth building phase. If you're still growing your nest egg, your focus should be on long-term growth, period.
And here is probably the most important warning of all. These funds, while they produce high income, are not risk-free. Far from it. The advisor put it bluntly. In a big market downturn, the value of your initial investment could drop by over 20%. That is a serious risk, and you have to be okay with that possibility.
So let's just boil it all down. These ETFs are tools for one job and one job only, creating cash flow. They are not a safe place to park your money like a savings account or a money market fund. Their goal is not to protect your principal at all costs. They're completely different tools for completely different jobs. You wouldn't use a hammer to saw a board, right? Same idea.
Okay, so we've walked through the person, the plan, the specific tools, and all the really important warnings. After all that, what is the big idea? What's the ultimate lesson we should be taking away from this whole case study?
And here it is. This is the core principle. A successful, sustainable retirement isn't just about having a big pile of cash. It's about structuring that money in a smart way that solves two problems at the same time: how to pay your bills today, while also making sure your portfolio keeps growing for all your tomorrows. It's all about the balance.
So this leaves us with one final question, and this one is for you to think about. This case study is a fantastic example, but your situation is totally unique. So the real question is, how can you take this core idea, this balance between your need for income now and your need for growth later, and actually apply it to your own financial plan? That's the most important question for anyone thinking about their future.